Welcome. We are going to look at question 5. Question 5 of this paper. This is the ATD May 2021, ATD Level 2 Financial Accounting May 2021 paper. And this is question 5 of that paper. So state whether each of the following items should be classified as capital expenditure, revenue expenditure, or income. State whether each of the following items should be classified as capital expenditure, revenue expenditure, or income. Okay, so number 1, and this is just 1 mark, so you just state and you move to the next one. Legal fees in connection with the purchase of premises. Legal fees in connection with the purchase of premises. This one is a capital expenditure. Legal fees in connection with the purchase of premises is a capital expenditure. Any expenditure that you incur to put an uncurrent asset into use. It's an incidental cost to put an uncurrent asset into use. It is required that you meet that cost before the asset in question can be put into use, or you can start enjoying the benefits of that asset. That becomes a capital expenditure and is supposed to be capitalized. So legal fees in connection with the purchase of premises is a capital expenditure. Without incurring these legal fees, we may not be able to purchase that particular house. Then so that one is a capital expenditure. The next one, cost of repainting a building. Cost of repainting a building. This is quite tricky. If you are talking about an old building and we need to repaint it so that it can continue attracting more money, then in such like a case we talk of this being a capital expenditure. Chances are very high that this will be a capital expenditure. No, repainting a building, it's not an everyday kind of a thing. It's something that will be repainted once and then it will stay for quite a long period of time before we repaint that building again. So that cost is going to be capitalized because we will not be incurring it every now and then. It's a one-off cost. We repaint the building, and basically it is to put that building into use for a considerable longer period of time. Unless if it's something that we have to do every now and then, which I really don't think if that is the case when we talk about repainting a building. Something that you do once and then it stays for a considerably long period of time, and it's that repainting that will basically put that building into use for quite a longer period of time. So cost of repainting a building, I will say it is a capital expenditure, unless if it is done frequently to the point that we can make it an operating kind of an expenditure. It's also possible, especially if the use of now that one comes back to the use of the building. How are you using the building? Because sometimes the use of the building can make it a revenue expenditure. Otherwise, the way they have given us here, I think we'd better go with capital expenditure. It's not something that we'll be doing every now and then. Proceeds from insurance compensation. Now, insurance compensation. The proceeds from insurance compensation, these ones are not treated as other incomes. This is not treated as other incomes, especially if you are talking about, it depends. If you are talking about, say, even the proprietor's life or something, proceeds from insurance compensation, that one, you are just being reinstated to the same position you were. The insurance doesn't benefit a person in any way. It reinstates you to the same position you were before the loss occurred. So it should not be treated as an income. It should not be treated as an income because the insurance company simply reinstates you to the same position you were before the incident of the loss occurred. So proceeds from insurance compensation, not an income. You're only supposed to go back to the same position you were before the loss occurred. So even if they pay you a check, that check is meant for a certain use. So simply reinstate yourself to the same position you were before the loss occurred. And so there's no chance for us treating that as an income. Insurance premiums for a new vehicle. Now this is also quite tricky. Normally insurance premiums are treated as revenue expenditures because it's something that can be even done on a monthly basis. So they are normally treated as revenue expenditures. But in this case, the examiner is very specific on insurance premium for a new vehicle. You know, a new vehicle must have the first insurance is meant to enable that vehicle, run. Without the first insurance, you may not even be able to get that vehicle from where it is. If you are talking about the port or whatever, that first insurance is meant to ensure that the vehicle runs, goes on road. So without the first insurance, the vehicle will not be in a condition to run. I hope we are clear on that. So insurance premium for a new vehicle. The fact that we are talking about a new vehicle, we are simply saying that this insurance premium is meant to put this new vehicle in a running, in an operating kind of, to start operations. So in such like a case, we can capitalize this, but the first insurance only. The subsequent premiums, those ones will be revenue expenditures. So for the first insurance premium that you are going to pay, basically that one will be to put the vehicle into use or into a usable condition. That one will be capitalized. So this will also be a capital expenditure. Capital expenditure, because we are basically putting that vehicle into use for the first time. Without paying for that insurance, that vehicle may not be in a state that can be used. Then cost of training staff to operate a new machine. Any cost that is related to that new machine, putting that new machine in a condition ready to serve or ready to operate, that will be capitalized. But this is a totally different angle of looking at things. We have introduced a totally different vote head here. Training staff. Now, training staff, so far, staff are not treated really as assets to an organization in accounting. And so, the cost of training this staff to operate a new machine will not be capitalized in any way. It will only be, the best it can go is a revenue expenditure, because the cost associated with staff is normally treated as revenue expenditure. Let's look at salary, let's look at wages. All of them are revenue expenditures, operational expenditures. So this is, even if you train, even if we are talking about training the staff so that it can now be able to operate a new machine, it's a bit remote from the machine. If you are talking about costs that are directly related to the new machine, to put the new machine into working condition, then that one can be capitalized. But here we are a little bit going remote by going to the training staff. Staff generally are not treated as assets; they are treated as revenue expenditures. And you might train them today and tomorrow they resign. So again, that one makes it, it loses that aspect of capitalizing it. Because when we talk about capitalization, something that is supposed to be used for quite a longer period of time. Revenue from sale of scrap metal. This one can be included as other incomes. It can be included as other incomes, especially when we sell scrap metal. The assumption here is that the object is now obsolete or it's worn out, so the remnants. Those ones, if you sell, they can be recognized as other income. So this one will come under other incomes, yes. So incomes. So how many capital expenditures do we have? 3 capital expenditures. This is not an income. Then you have 1 revenue expenditure and other incomes also have it there. So that's how we'll go with that. Then number 2, in the context of public sector accounting, explain the following. Cash accounting. Cash accounting is a system of accounting. Majorly used by the government, and it records receipts or recognizes receipts when they are actually received, and it also records payments when it's actually paid. So that's how it goes. Receipts are recorded when they are actually received. Payments are recorded when they are actually paid. So it captures the receipts and payments as and when they occur. That is the cash system of accounting. Majorly used by the government. It records receipts when money is actually received, and it records payments when money is actually paid. Expenses or expenditures are recorded when money is paid, and the incomes are received when are recorded when money is actually received. When we talk about commitment accounting, this is about anticipation of the future costs or incomes. So, commitment accounting, this is a system of accounting that requires that, just create some space so that we do some notes here, which requires that funds all funds that are required, that are to meet the future, requires that funds that are to meet the future obligations, are recorded immediately. They are well known or identified. So it requires that funds which are to be met, in the future, are recorded immediately. They are well known or identified. It requires that all funds required to meet future obligations are tracked when known, so that you can commit the resources to those particular engagements. So the moment you can foresee the need for these funds, whether they are coming in or out, the whole the whole concept here is that we need to factor that into to put that into consideration. Once we anticipate the future obligations, we put that into consideration. That is the commitment accounting, so that we can set the resources aside to meet those obligations as and when they fall due. So this policy sets out the requirement to track all material commitments. It can be the requisitions, it can be the purchase orders, it can be contractual obligations, regardless of the financial system that we are currently operating in. So commitment accounting, let's try to track down the future expenditure, and then we commit or we put resources aside to meet those expenditures or obligations as and when they fall due. Then we have the last part of this question. Discuss five fundamental principles of professional ethics that a professional accountant should be guided by. Fundamental principles of professional ethics that an accountant should be guided by. Number one, we have integrity. And this is about being straightforward and honest in all your undertakings and dealings as an accountant. Integrity is a fundamental principle of professional ethics that a professional accountant must be guided with. Number 2, we have objectivity. Objectivity, and this is free from bias. Free from bias. Making informed decisions. Independent decisions that are based on facts. So these are factual judgments from a well-reasoned person who is free from bias. Objectivity demands that you put aside conflicts of interest and undue influence, and you focus on the facts that are before you to make a well-informed judgment. Then number 3, that is the third fundamental principle of professional ethics, is professional competence and due care or diligence. This is where a professional accountant must at all times exercise the best of his knowledge and skills. So he should apply the accounting, the professional knowledge and skills at any given engagement, and he should also seek to update his knowledge and skills at any given point in time, so that he can work without any cases of negligence, without any cases of failing to do what is expected to be done by a person of his stature. So professional competence and due diligence, very important. And basically what we are talking about here is continuous professional development for this professional accountant. Number 4, confidentiality. That all information that this professional accountant has access to in the course of duty must be safeguarded. It must not be used for other purposes outside there, where you might infringe on another person's right to privacy. So any information that is related to work must be treated purely for work and not for any other kind of a transaction or engagement. Information about the client should not be disclosed without his or her express authority, and should not be used in any way that will harm the client. Then number 5, professional behavior. That a professional accountant must always carry himself in a way that befits the stature bestowed upon him as an accountant. So he should at all times adhere to the professional code of ethics and conduct, so that he doesn't bring about disrepute to the professional body that houses him. So these are the 5 fundamental principles of professional ethics that a professional accountant should be guided by. It should be integral, it should be objective, it should at all times practice professional competence and due care, it should be confidential, and he should also behave professionally as captured in the professional code of ethics and conduct. So this should be able to give you the 10 marks. Thank you. Let's meet in the next question.